Welcome back into the second hour of the Big Money Show. I'm Dagan McDowell, along with my fantabulous co-host. And joining us for this terrific hour, Great Hill Capital Chairman, Thomas Hayes. Nice to see you. Another big win on the economy for President Trump. Tariff cash pouring in, and now the Treasury is flashing a $27 billion surplus, this for the month of June. President Trump says America's back.
Our country is making a lot of money for the first time in a long time, in decades. We have a country that was dead. It was a goner 1 year ago, and now we have the hottest country in the world.
Thomas, how do you see these numbers? Because this is a consumption tax, but better small consumption tax that is borne in large part by exporters from other countries, and then you cut taxes here at home and create incentive for work.
Yeah, it's absolutely, one, it's a surprise in the sense that we came back to surplus so quickly, okay? $27 billion in surplus. We collected a record $27 billion in tariffs. That's up 4x, okay? And they're expecting over the next decade $2.8 trillion of collected tariffs. And then you've got the tax cuts to spur growth at the same time. And to your point, Dagan, I think you nailed it. It's not all being borne by the U.S. consumer. It's being borne by the exporters. Why would they be pushing back if it was all being borne by us? The last thing the Japanese or the Chinese or the Europeans are worried about is the happiness of the U.S. customer. They're worried about their bottom line, and they're pushing back hard. And I like the way President Trump has put these deadlines on, because they know he's flexible to talk and negotiate, but they also know that's a real deadline. The spigot starts and the tariffs go up on that date. So it's like, we're going to talk, we're flexible, we are rational, but if you don't play, you're going to pay.
You know what's also at a record in the month of June? Interest on the debt. The interest on the debt, it was last month $144 billion. And you're welcome to comment on this, but we're kind of...
We got a little catching up to do, is what you're saying?
Well, $144 billion, that is roughly, so the average for the year, the fiscal year, we're paying $108 billion per month in interest on the national debt. Year to date, fiscal year to date, tariff revenue is $108 billion. So that year to date tariff revenue barely covers 1 month of interest on our debt.
Yeah, but I like, so that's a big problem, right? I mean, the spending is the side of the issue that nobody was really happy about with the big, beautiful bill. You got a little bit of it, you didn't get a ton of it. I'm totally with you on that. I do think, though, the key point is where you're shifting the burden of taxes, Dagan. I am a way bigger fan of consumption taxes. If you can cut taxes on productive work and give people a chance to earn higher incomes all day long. And you know, when you talk about this is $27 billion in revenue, and it's not on the tariffs that Trump has threatened. It's on the tariffs that he put in place when he set all those aside, which is more in the 10 to 15% range. So if you're the president of the United States right now, you're threatening 30% on the EU and 50% on Brazil or whatever, you can get what you've gotten at 10 to 15%.
Yeah.
You can cut deals at 10 to 15%, still get the tariff revenue, but avoid the dislocation that could really slow down the economy. That's actually kind of a nice deal. And it helps to fund a little bit the tax cuts at home. So I think we're sort of in a sweet spot range right here. And I would hate to see us move too far out of this sweet spot range, because I think he's found it already.
I think that, Dagan, I hear you on $108 billion per month. and the tariff revenue not being a drop in the bucket when it comes to the interest we're paying on the debt. But I also think about what would have happened if Kamala Harris was president. We would still have the same debt problem. It would be ballooning even more than it is now, and we wouldn't have that tariff revenue to help at least offset it. You know, the way I approach this is I think about what he's done with respect to waking up the American people, whether it's tariff revenue, whether it's DOGE cuts, whether it was explaining to people that other countries just demand a lower price for prescription drugs, and then we have to offset and pay a higher price to be able to make up the difference. He's trying to level the playing field there. I think people realize that these countries have gotten away with a lot for a long time, and the president is trying to make inroads with that. And, you know, even with DOGE, for example, if the cuts don't end up being as deep as Elon Musk had promised us, which they won't, and even if they don't sort of go the distance and stand the test of time, the conversations I hear of people just waking up to the fact that there was so much fraud and abuse in the system, or with respect to how countries were ripping us off with tariffs, is really, really important in education, shining a light on it. I think that's valuable.
I have some good news. I did a cold take last hour, so I'm going to do a hot take this hour. In a little-known report published by the CBO, they come out and they've explored alternative scenarios to their baseline for the debt. They say if productivity growth grows just 0.5 point higher each year, our debt peaks in 2040, stabilizes, and starts to roll over. We run a primary surplus excluding interest payments. By 2049, gross national product per capita is 17% higher than their baseline by 2055. Productivity, AI, maybe, you can weigh in, could save us all from this. Labor productivity last year jumped 2.3%, following a 1.6% increase the year before. So that's a 0.5 point.
Yeah.
So if we continue to see 0.5 point increase like we have been, we can grow our way out of this problem. Now, if we keep spending like we've spending, then that's the issue.
Well, this is where you go back to Besant. You've got to re-leverage the private sector. You're not going to get productivity growth from government. So
but if you can get it in AI, and then you tell Congress, get your butt in order and stop the crap spending, stop the bailouts here and there, we might be okay by 2050.
Yeah.
That feels like a long time away. I want to get more okay sooner than 2050. I'm just saying.
It's going to be hard to cut the spending. I mean, as we saw in the big, beautiful bill, you know, they wanted to cut certain things or slow the spend on certain things, and everybody was freaking out. And you had issues on both sides of the aisle.
They're still fighting over the $9 billion rescission package? You can't do $9 billion you can't cut, and you're going to tell me we're going to deleverage?
But what if we just keep debt spending the way it is, and productivity starts to arc the curve of the debt, where then it starts to roll over?
But that
go ahead.
No, I was just going to say, tax receipts in June were up 13%. This is even before the big, beautiful bill. And outlays were down 7%.
That's
so
right.
this is heading in the right direction. What were you going to say? The only thing is, I love the CBO just leaves out interest in that calculation.
Which is why I looked at you when I said that.
That's kind of the problem.
Couple of things. I think DOGE is probably going to be more successful than anticipated. Spending was down. Part of the surplus spending was down $187 billion in June. Okay. 2, productivity. We haven't had this acceleration of productivity growth since the 80s. And if we do get exactly what Taylor's talking about, the only way we're getting out of 120% debt to GDP is growth. Okay. So the policies are in place. We've just gone from, bombs and tariffs to now we're talking about growth, and we have tax cuts. Wait till we get into massive deregulation and unleash businesses. Bonus depreciation in the one big beautiful bill. That is massive for large business, but it's massive for small businesses. So I think you're going to see animal spirits come back. If you look at household balance sheets in aggregate, if you look at leverage of S&P 500 companies, it's near record lows. There is a lot of credit expansion can happen. I'll tell you what's gumming up the whole system is artificially high rates. So when we talk about $1 trillion a year of interest, we could fix that tomorrow. If a shadow Fed is announced, the market's going to start to price in that lower interest payment and those lower rates. And I got to tell you, in the 50s, when we were at debt to GDP 120%, we ran inflation a little bit hot. I got to be honest with you, 3 to 5%. And you know what happened? Debt to GDP went from 120% in 1948 to 63% in 1958.
Because you inflate
Good ratio, Taylor.
I don't know about inflating your way out of your debt. I don't love
You
that.
inflate away.
I
You
don't
inflate
vote on
away
It's a
the debt.
combination. Nominal GDP has to run hot, and inflation a little bit above trend. It just goes hand in hand.
You want to inflate your way out? I didn't have that on my
the only
bingo
way.
card today,
I want
Tom.
a little bit of all.
I didn't have that on my bingo
31
card out
flavors.
of you today.
I
I'm not
want
gonna
some
lie.
productivity growth. I want some deregulation. I want some tax cuts. I want some
want it
re-leveraging
all.
of the private sector, and we can absolutely rock and roll. Look, we've got the biggest portion of our population, the millennials, 72 million at perfect age of productivity, of spending, of starting new families. This economy can hum, and President Trump is setting the table for that.
What
to
if they
happen.
can't get jobs because of AI? We were just talking about that in the last hour.
Well, it's interesting. There's not been a case yet where a disruptive technology, it certainly displaces, but people go back and new jobs and new
Right.
industries are created to service the new technologies, or the freedoms that the new technologies creates new cottage industries that employ people. Maybe you'll just be playing golf all day, and the golf companies will do incredible business because everyone's playing golf, nothing to do. But that's an exaggeration. The point is that I don't think we're going to get to a point where we're sitting at home watching TV, getting universal basic income because there's nothing to do. We'll figure out something to do. It's human nature. Humans like to grow. They like to be productive. They like to contribute, and that won't change anytime soon.
My biggest concern isn't how technology, because again, technology equals productivity, and the AI, it will just change the jobs that people do.
That's right.
However, it's that young people are forced to prop up Social Security and Medicare because those jackasses in DC won't fix it. And it siphons all of the money out of our young workforce in this way. Last month, the interest on the national debt, $144 billion. That was more than what we paid out in Social Security.
Yeah.
And it was also, the debt cost more than all of the following departments: ag, commerce, defense, education, energy, homeland security, justice, labor, state, transportation, plus EPA and NASA combined. That's your interest on the national debt.
Yeah.
Apple.
I did this one just for you.
Thank you.
So we got to get to it. Apple. So you watch Formula One, right?
Yeah.
So right now you have to watch it on ESPN. It's about $90 million a year is what ESPN pays Formula One for the rights. Apple wants to come in for a bid. They will offer $150 million. And you can then watch Formula One if they get the bid on Apple Plus. But I think a lot of people are worried, Dagan, is Apple Plus the same as ESPN? Do you get the same viewers? Either way, Apple coming in strong. Uh-oh.
Can they just put racing on one channel? NASCAR has been on 3 different channels every year for God knows how long. And right now, I think the race, they raced where, in Sonoma last night? It's on Amazon.
Yeah.
It took
Can't
me
keep up.
days to try and walk my father through Amazon Prime so he could watch racing.
They need an AI to help you figure out where to watch your racing. Maybe that's
and
it.
it's just, would I subscribe to Apple just to watch F1? No.
No?
No.
Oh, I thought for sure you would.
There you go, Apple.
No, I would not.
Would you do it for NASCAR?
No.
Okay.
I'd go to your local dirt track
All
and
right.
experience it in person.
Watch it
That's
live.
my advice. Coming up, the next big test for this market, earnings. Will strong numbers keep this rally alive? Stick with big money.
When you can't watch, listen. Get the latest news, business, and news headlines on SiriusXM anytime.
Markets have learned how to read President Trump's trade policy, weathering the White House's recent tariff storm. But a fresh set of earnings this week will be a new test. We get results from America's top banks, JP Morgan, Wells Fargo, Citi, all tomorrow. Tom, look, I don't care what happens to their trading revenue.
Yeah.
I don't care really what happens to their investment banking revenue. It's probably all good. But I do care what they have to say about the health of the consumer, the credit cards, the economy. What do you want to hear from them? And then more broadly, this earnings season, frankly, to me, has felt like it's been on fire.
Yeah, look, the secret to happiness is low expectations, and that's what we're coming into the season with. Expectations were over 9% just 3 months ago for this quarter. They're now down to 4.8%, so we don't have to jump over the bar, we just have to step over it, and I think that's what you're going to see with banks. Bank of America credit card spending data for June was up. Confidence is back. There was a lot of, you remember consumer confidence during April and May. The consumer was worried. There was uncertainty. And then there was some rationality in terms of policy. People's confidence came right back. You go to the restaurants, you see what's going on. I think that what we're going to see, we saw the stress tests were very strong. I think we're going to see another quarter of beat from the banks. That's going to kick off the thematics for this quarter. And it's going to come in better than expected. The key is really going to be guidance looking forward. And I do think you're seeing CEO and C-suite confidence come back the last couple of months. And, you know, the thing I've learned in this business is, look, the market feels overbought right now. It feels like it's come a long way in a short period of time. What I've learned in my career is these V-shaped recoveries, the overbought signals that are normal in a regular environment, a trading range type of environment, can stay extended for a long time coming out of a V, because so many people got caught off sides at the lows. They are forced in every new trade deal, every new earnings report, and they've got to get that money to work. And where they're going to do it to catch up on performance, they got to go for the laggards, the things that haven't moved yet in the second half, and we're seeing that the first few weeks of the second half.
Well, I was just talking to somebody who was saying it was also the retail investor who really benefited the most from the lows that we saw at Liberation Day, but that the institutions didn't necessarily get in when they were supposed to. So that goes to your point that if they're legging in slowly, then this market has room to run. The same person was also telling me that he likes financials right now, and I'm like, really? Looking at Goldman Sachs and JP Morgan, it's difficult for me. Like, that's like buying Palantir or NVIDIA at this point. Do you think there is still room there?
I don't think it's the highest and best use of capital right now. I do think there is some room. I think guidance is going to be okay. I think deals are coming back, but they've run a lot. I think you hit the nail on the head. So some underperformers in the first half that I think could start to see some bids. Consumer consumer discretionary. Okay, people have been down on that because the consumer has been uncertainty. I think a lot of those have gotten beaten up. The Nikes of the world, even the Advanced Auto Parts has doubled off its lows recently, and some of those areas that are also still in a little bit of tariff uncertainty as it relates to consumer goods. The Lululemons. We don't own Lulu. We don't own Nike, but we own similar type of companies, and I think they're going to start to get bid in a material way. I think energy is actually, there's some value starting to show up in the servicers. No one wants them. And I think finally, even though they're getting hit with some of the Medicaid and spend, I think healthcare, some aspects of healthcare have really been hit. So I think you want to kind of go towards where the puck is going, not where it already is. And I think financials and tech have had a good run here.
I agree with you, but you explained it better than I could.
Oh,
Brian, what are some of your general thoughts?
Well, I love how bullish Tom is on this stuff. That's why I like having you on the show, because you just got so many opportunities. I'm kind of wondering about these companies giving guidance, though, because you caught my attention last week with Delta.
Yeah.
No, they were sort of doom and gloom first part of the year, and then they came out and said, actually, things look good. Now, Charles says that's because of first-class bookings. I don't know about that. He was kind of down on my McDonald's and Chipotle, but I went in there today for an Egg McMuffin, and the line was very long.
Snack wraps.
Yeah.
I don't know about the snack wraps, but I'm thinking, how do these CEOs navigate guidance with the tariff situation here? Are they going to kind of do? We didn't get as much of it last quarter as we thought. Okay, they sort of were a little more mum about it. Are they gonna be more bearish about it now that they've got a little more visibility, or are they going to start doing a little bit of an about face and saying, I don't think it's going to affect our company as much as everybody thought? And I guess I'm leaning in the camp that they might say they've got a better handle on this than people thought they would. And I think that's going to be very bullish for the market.
Yeah.
Dagan, weigh in.
Who was it? Peter Lynch, the famous investor at Fidelity, the legs pantyhose investment.
Yes, buy what you know.
Am I dating myself? Does anybody know?
I remember
legs
legs.
pantyhose?
Of
They
course,
came
in the
the
little dome.
a little
Yeah.
egg.
They had them at the 7-Eleven.
It was the buy what you know. That was Peter Lynch's investing philosophy. I would short what I know, and that would be Delta. I think that there has to be an airline that is ready to take advantage of Delta's suckitude, because Delta used to be just the best in class.
Yeah.
We treat everyone so magically, and they have wildly oversold because the stupid credit cards, their lounges have not fixed that problem at all. The service is in decline and poor. What you get, the bang you get for your buck, is not there. I think that on the margin that United is rolling out this new business class option. Delta is ripe for the picking.
I have not been on a Delta flight in I don't know how long that has had one open seat. And I know they're overselling.
No
I agree.
have any open
But I'm just saying,
anymore.
like, there is no open seats on these flights.
I think, Dagan, you might be spot on. I fly United every month, straight out of Orange County to Newark, and I've had great experiences. So maybe to your point, I think the whole basket though of airlines has been so beaten down. So when you're buying that, you kind of want to buy the best balance sheets and the best financials. So Delta still has good financials relative to the peers. Maybe United, but beyond that, you start to get a little bit dicey.
Yeah. Speaking of financial conditions, I did want to point out E.J. Antoni. I was quoting a lot of his work on the interest on the debt the last couple of hours, and he pointed out that national financial conditions have continued to loosen. Yeah. And last week they matched the 52-week low, and this was before the latest tariff announcement. So maybe things get a little bit tighter, but loose financial conditions are.
By the way, it's so funny when people say if Powell lowered rates to close to the level of inflation, which would be neutral, it wouldn't affect mortgages because they trade off the 10-year yield. That's completely false. Yeah. You know what game comes back the minute he lowers rates? 5-year and 7-year adjustable arms. And that gets everyone back in the game, and it completely changes. You talk about productivity, putting people into high-paying jobs, middle-class jobs, and having what happened in the first term of Trump, where regular, everyday people's real wages went up. Main Street did better on a relative basis during Trump's first term than we've seen in the previous administration. We're going to see it again.
Yeah. Jackleg Jay, loosen my financial conditions.
Exactly.
Okay.
Seriously. Yeah. I want just that mortgage lower.
Oh, and by the way, all the trapped equity in people's homes, wait till they lower rates and you see the HELOC game come on.
Yeah.
Right. Okay.
Yeah, that's true.
Meanwhile, we want to talk about another story. Relief efforts continue to be underway for the devastating floods in Texas. Fox Corporation is taking part. Go to go.fox/Texas flood relief or scan the QR code on your screen to donate. Our generous viewers have answered the call to action across all of Fox platforms, and listen to this, have helped raise $5 million to aid Central Texas communities. Wow. Well done. We'll be right back.
I don't disclose specifically what my dot is, but as I've said before, I do think we're pretty close to where the neutral rate is. And so I see an economy that's resilient. I see one that's working really well. And I don't see a need to really reduce unless we see material weakening on the labor side.
That was the Cleveland Fed President Beth Hammack telling Fox Business in an exclusive interview that she doesn't see the need to cut rates quite yet. Meanwhile, National Economic Council Director Kevin Hassett says the White House is investigating the Federal Reserve's $2.5 billion renovation project.
The bottom line is that this is the most expensive project in D.C. history. So the Fed has a lot to answer for. And the bottom line is that there's a key statutory problem. In 1913, when we founded the Fed, the U.S. was under a gold standard. So it was never envisioned by the people that voted for the construction of the Fed that we currently see, that the Fed could print money and toss it around willy-nilly because they had to have the gold to do what they're doing.
This comes as President Trump continues to ramp up the pressure on Fed Chair Powell to step down and make way for someone who will finally lower interest rates. Hassett says the White House is looking into their authority to do that. Okay, so, Tom, these guys think the economy is pretty strong, like you.
Yeah.
And they say for that reason, unlike you, why are you all talking about interest rate cuts?
Yeah, I think a couple of things. One is you've got 16% of GDP is housing related, and those are the high paying jobs. Number two, the biggest portion of our population is the millennials, and their ability to start their lives, housing and family formation has now been delayed by 5 years unnecessarily by this policy. And number three, like everyone at this table, we pay a lot of taxes. And those taxes, $600 billion are going into unnecessary interest expense determined at the hand of
Can
one
I push
person.
back, though?
Yeah.
That's not the Fed's mandate. I hear you.
Yeah.
I wish we could all get a home and a mortgage again for 3%.
Yeah.
That's not what they're there for.
That's correct. So dual mandate, maximum employment. Okay, we saw the jobs report like Charles was talking about, not as great as advertised. Okay, and inflation has been low, very, very low. So
They have reasons
The real issue is they're supposed to be data dependent by mandate. They've now shifted in the last 30 days to being prediction dependent.
Yes.
Now, this was the same guy who said quantitative tightening was on autopilot in December of 2018. I remember because I was at Disneyland and the market was crashing 20% in the month of December because he didn't know what he was doing. And Mnuchin had to call a meeting of the bankers on Sunday to bail him out Sunday night, and they juiced it and they turned things around. Then he did transitory, and now he is certain because his crystal ball has been so good.
Then he cut rates before the election.
Well, there you go. And now he's certain about his predictions.
But his predictions are like yours. I mean, his predictions are the economy's not slowing down enough to justify a rate cut.
Except he talks out of both of his mouths, because in the summary of economic projections, real GDP he's got at 1.4%. How can you say that we can't cut rates if real GDP in their own projections, summary of economic projections, last meeting, 1.4%?
Can I push back again?
Yes.
He's one vote, and his vote is no more important than any of the other 11 members.
Yes.
Do we hold him to a higher standard because he's Fed chair? What about all of the other 12-0 votes that we talk about?
Yeah, I think as chairman, he leads the tenor, and it's incumbent upon him to present the data that is supportive. Look,
They're all part of the swamp, Tom.
They're part of the swamp, and this lady who just came on and said we're near the neutral rate. How do you get to that math? I could go to my fifth grader and say, listen, the Fed funds rate is at 4.25, inflation is at 2.8. Does that look like it's about the same number? And she'd say, no, that looks pretty far apart. And I'd say, well, then that's not neutral. And that old dog don't hunt, as we say. Dagan probably knows that saying.
Come in on that saying, Dagan. Weigh in on this.
Now, I was just looking at a lot of the Federal Reserve data in terms of, again, I go back to EJ, but the fact that their balance sheet is still almost 60% above pre-pandemic levels, and they've now slowed down their asset sales to a crawl. Those are EJ words. We're never going to get back down to levels. I look at all of this. What if there's a crisis?
Yeah.
What the hell are they going to do if there's a crisis?
Right.
Yeah.
How much are they going to blow out the balance sheet and losing, again, the Federal Reserve losing money? They're supposed to remit the money. Are they still losing money, or they have
The last 3 years they lost money, right?
Supposed to remit it back to the Treasury Department. Instead, what are they doing? They're paying hundreds of millions of dollars in interest every day to the banks.
And they're building that $2.5 billion. I want to get in on the $2.5 billion building.
The $2.5 billion renovation of the building, which was inappropriate and unnecessary right now. I saw this alert on Friday because we'd been talking about this renovation for quite some time, but it finally was gaining some traction where there were rumors that it seemed like Powell might have to feel some pressure to step down. I don't know where it's going per se. The president certainly thinks that he should, but you do have to ask yourself, if you were running the, essentially helping run the balance sheet of the country and you can't manage your own books, effectively, then what are you doing?
Yeah, the proof is kind of in the pudding there, maybe. Taylor, I want to switch gears, though, because you're looking at Mattel, and I'm always interested in the stock.
This is the most exciting story of the day. You know why? Road trip, we're all going to Vegas. What does that have to do with Mattel? Mattel owns Uno. Palms Resort in Vegas this weekend is doing an Uno social club. So I don't know if we can bet.
Like, you're talking Uno the game or the pizza chain?
Nope, the game. We're all going to sit around with the Uno cards in Vegas at the Palms Resort this weekend. It's unclear. Uno hasn't confirmed if it's gambling or not, money or not. For now, it's a social club where we can all sit around and play Uno. But it's going to be amazing. And we are waiting on confirmation for more Uno clubs that are expected to open later this year and where. The National Museum of Play has called Uno America's favorite game. TBD. What do you guys think?
Well, so I've never thought I want to go to Vegas to play Uno.
I hate Vegas. I think it's an armpit. I definitely don't want to go there to play.
Oh, you just don't want to go there at all.
I don't want to go there at all.
Brian, you're missing a whole boat. My 11-year-old loves Uno.
Mine too.
I have yet to beat her at Uno. And it will now be an excuse to go to Vegas. It can say, hey, we'll go play Uno together, and we get to go
teach them at 11 to how to play cards for money. I mean, not that Uno, but then the environment.
No, but
how's she going to take over my investing business if she doesn't understand probabilities?
Uno's a great game, but if you're going to Uno in Vegas, like, how could it not be for money? It's got to be for money, right?
Well, we don't know yet. All I know is Uno beats Old Maid any day, so I will absolutely go play Uno.
Why would you play any game not for money?
That's what I'm saying. It's got to be for money. I don't know Uno for money.
I have one question. When is this little get-together?
It starts this weekend.
Okay.
We still have time to book our flights on United.
There are no empty seats. You cannot find an empty seat.
Here's an alternative. Instead of going to Las Vegas in the middle of July, just go and lay buck naked on the asphalt in your local Walmart parking lot. That is as pleasant, because that is the equivalent of going to Vegas in July. This
took a turn.
Even if you're inside.
Okay, fine. Tom and I are going to play Uno with our nieces, nephews, and children in Vegas.
That'll be fun.
I'm going to the Walmart parking lot.
I'm never looking at a Walmart parking lot the same way again.
Oh, my goodness.
Coming up, the bar for being a part of the middle class may not be what you think. We'll explain when Big Money returns.
Don't feel like doing anything. I just want to lay in my bed. Don't feel.
Welcome back. A stunning new report showing that nearly half of Americans who call themselves middle class aren't. In reality, only 51% of U.S. households fall into that category. That's down from 61% back in 1971. And even if you are middle class, it might not feel like it. A new survey shows that half of American adults say they're, quote, constantly treading water financially. And this middle class range, just to be clear with the viewers, as defined by Pew, is $56,600 on the low end to $169,800 on the high end. Now, I understand in some parts of the country that could very well be middle class. If you're living here in New York City, after you've paid taxes, federal, state, and city tax, you're going to be surviving on pizza, basically, to try to get by, especially with how expensive rents and everything else have become. So it does vary region to region, but people feel, Tom, like they're not. It kind of goes to your point, like they're not
getting
anywhere.
Yeah, I think that's the case. And I will say, in my adult life, the one period where I felt like Main Street was booming and feeling happy was in President Trump's first term. The policies, people were optimistic, but it wasn't just like hope. It was their real wages were actually going up. And I do think this bonus depreciation, and I do think the tax is not going back up on businesses, is going to recreate that environment and is starting to recreate that environment. So let's be hopeful these numbers start to improve and we move back towards 55, 61%, and this range starts to go up. But again, you need the high-paying jobs, and that's what President Trump is trying to do with reshoring manufacturing, with opening up federal lands to build houses. Those are major components to the economy that have been kind of left for dead.
And whatever the definition of middle class is, if we're going to go by the Pew definition, President Trump is trying to strengthen that. Whereas you had Democrats in office that were trying to actually, they said we're working for the middle class, but they weren't actually working for them, and they were trying to shrink the middle class, Brian, and essentially, you know, I mean, if you believe that the progressive part of the Democrat Party wants just an elite and then everybody else, there's no room for middle.
Well, you got a stagnation on people's wages under Biden for sure, and I think that's what gets people upset. It's if you're not moving in the right direction, you feel like you're going backward. I will say Mark Perry does some fascinating work on this, and you can have the middle class shrink because people move down into a lower class, or it can shrink because the quote-unquote upper class actually gets a lot bigger. So Mark Perry has this, I think it's great data, 1967, this is inflation, constant dollars. 1967, 13% of Americans made more than $100,000. Again, in 2023 dollars. Today, that number is almost 41%.
Wow.
So the middle class has shrunk, but a lot of that has moved up. Now, I think what's interesting, to your point, is under Trump, that share that was above $100,000 really increased fast.
Yeah.
And then under Biden, it actually went backward a little bit and sort of stagnated. So I think a lot of what people feel is they know the potential of this economy. They saw it under Trump. Then they saw the opposite under Biden. And that really does feel like a squeeze when that good momentum starts to go backward.
Growth solves all of our problems, like you just said, right? Is 3% GDP. That's why I finally got sold on the BBB, even though I don't always love all portions of it. Because I think, Brian, I was thinking that about how are we defining middle class? Have the parameters changed of how we define it? And is it because more of us are able to climb up that ladder and go into more of an upper class?
I do think that you cannot overstate how important it is to be able to buy a home.
Yeah, I agree.
And it is the intangible that goes, it's not just the raw numbers, it's the intangible of the community, your church, and your ability to start a family and buy a home.
And
the income you need,
stability, just a sense of accomplishment.
I mean, when the income you need to buy a median home goes from $79,000 in 2019 to $127,000 today. Even being rich, you can't buy a home. I agree, that's a problem.
All right, coming up, student loan borrowers, they're about to see some big changes. We're going to break down the impact of President Trump's big, beautiful bill law, as Dagan says, after the break.
Now that the big, beautiful bill has been signed into law, big changes are coming for millions of student loan borrowers. Lydia Hu is here with the details. Lydia.
Hey there, Brian. We're talking about new changes for repayment and also caps on new borrowing. Repayment options, starting there first, they're going to be consolidated from currently 7 options into just 2. One of those plans that will be phased out is the Biden-era SAVE plan. It has about 7.7 million borrowers, and some of them have paid as little as $0 per month. Well, that's all going away, and now all borrowers will have to pick between the 2 repayment options, a standard payment plan or an income-driven repayment plan. The new standard plan will stretch payments over 10 years to as many as 25 years, depending on the balance. And borrowers on the new income-driven plan will have payments capped between 10 and 15% of their discretionary income. Borrowers enrolled in a plan that will be phased out must sign up for a new plan in 3 years by July 2028. There are also new limits on borrowing. Grad Plus loans previously allowed graduate students to borrow the full amount of the cost for their attendance to graduate school, but those loans are now being eliminated. Now, borrowing for a master's degree will be capped at $100,000, and a cap of $200,000 will be in place for professional degrees like medical school or law school. Students will students will now have a lifetime maximum borrowing limit of $257,500 for both undergrad and graduate school federal loans. Now, we're hearing from some Democrats like Senator Elizabeth Warren who are critical of these caps on borrowing. She says these will keep people out of college, but Republicans are saying these measures are going to rein in debt and save the taxpayer from paying the cost. Brian.
All right, Lydia, great report. Thanks for that. Real quick, what do you think about this, Tom? I like it because basically if you just cut through all of it, it says y'all need to start paying your bills.
Yeah, I think that's personal responsibility. But I also think if you want equilibrium in the education world, allow people to disgorge their student loans in bankruptcy, and that will create an equilibrium overnight, because then the pricing will come down, then it will be risk versus return in terms of expecting a return on investment for education. Universities will have to deliver. Elizabeth Warren does not like this because she got paid $400,000 at Yale as a professor, and if you keep the prices inflated and you keep the spigots on with this subsidized lending, you're going to see tuition prices continue to go up. If you let the natural market play its course and you let that be disgorged, then they're going to have to deliver value for every dollar of tuition they receive.
But it's not a natural marketplace because the federal government,
Correct.
that's our money.
Right.
The federal government makes those student loans, and all those expensive universities are in Massachusetts, her state. Garbage.
And it's good
Responsibility and cash.
Yes, and if you're getting a professional degree, it's meant to pay, so pay for it. Charles Payne.